This has been a first-class event, and I've told all the company persons that today. It's been a year. It was a fast year. We were doing this with about half of this panel about a year ago. So we'll have a good, stimulated talk here. We'll leave some times for questions and answers. So just be thinking of your questions. These are a group of great guys here. One little comment. I've enjoyed the last 9 years very much with Larry Kudlow, and it was quite a ride and quite an adventure. And the greatest thing was about the last 4 weeks with the suspense of whether he would go to Washington. And so sometime over coffee, I'll tell you about that little reality TV show of a sort between Larry and I. First saying, wouldn't take it, and then saying, hope he doesn't call me. And then I heard in the news that he had taken it. So I said, okay, he got the phone call. And then actually it was a Sunday night phone call here. Larry and his wife were at a restaurant. Donald called him and said, got to have you in the administration. So that was it. Okay, today we have a tremendous panel, which I respect a great deal. Chris Massini, he is the research analyst with Capelli Gold Fund. Chris. And then Adam Crown. He is the financial advisor, wealth management. He is with Morgan Stanley. High net worth individuals, that's who he works with. Daniel Oliver, who was on the panel last year. He's the founder of Miracon Capital. Then Trey Reich. He is the senior portfolio manager with Sprott Assets since 2015. And then Ryan McIntyre, he's the co-portfolio manager with Tocqueville. And we've seen Tocqueville around for years. Let's start it off with Daniel Oliver. Daniel, the first topic here today, with cleaner balance sheets, lower mining costs, and somewhat improving prices, is now the time for greater deal flow in gold mining stocks?
Well, it depends what you mean by the question. I mean, of course, now is the time, but they won't do it. And the reason is because, as we all know, the way they play the cycle is they all have huge acquisitions at the top of the cycle and then have a near-death experience and sell assets on the way down and then wait till the froth comes back to buy them again. And that's driven by a few different factors. One is bank credit. The banks are most likely to blend at the top and least like at the bottom in terms of the cost of debt. And I also think my own theory on this is that the way the industry is run, one of the reasons it's so volatile is because, like every industry, but especially in the gold industry, the executives are compensated with the call options. And so the easiest way to increase the value of your call option is to dilute volatility. And the way you do that is you take out a debt and you buy a marginal property and hope to God the gold price goes up. And if it does, you make a lot of money. If it doesn't, you refinance and wipe out your equity, guys. But because there were so many problems so recently, I think all the majors are still gun shy, and they're waiting for gold to break out. We were talking earlier. I mean, this range between 1250 and 1360 is this sort of dead zone. And if it breaks below that, these guys are all in big trouble again, and they know it. And so they're holding their firepower. If it breaks through that, they'll have a lot of internal cash flow they can lever up and do deals. So I think they're waiting to see how that resolves, and they're all a little gun shy still from all the recent near-death experiences that they had.
Well, we're going to get to the M&A in a second, but all of this belt tightening, exploration was the loss there, right?
Yeah, well, and one of the problems is that the gold industry, like for example the farm industry,
right.
the way it works is the majors buy out junior companies for a lot of money, and the guy who wins the tournament gets a big payout. And the payout is designed not just to compensate the winner, but to encourage all the losers to keep trying. Right. And the same way it works in the biotech company. And so when you don't have those big payouts, and there haven't been a lot recently, it discourages the others from playing. It discourages the capital from going into these speculative companies looking for gold because they don't see the payout. And then on top of that, as we've been discussing, a lot of the Canadian spec capital that used to go into these companies is being rerouted to marijuana stocks and crypto scams. And so they're getting hit on both sides at the moment, and that's been bad for exploration, bad for development. But what will solve that is when gold breaks out eventually, which I think it will, and the industry will have enough self-generated capital. They won't need to have a lot of external capital coming into the space. They will do it themselves.
Adam, why don't you make a comment as well on is now the time for greater deal flow in the gold mining stocks?
Sure, thanks. From my perspective, what I would like to see as a financial advisor at Morgan Stanley is more deals and more M&A across the sector, across the industry, because it's hard to invest in the microcap companies in general for financial advisors. So I would like to throw out some numbers that would, put it in perspective. Per our Q1 earnings release, we manage, Morgan Stanley oversees $2.4 trillion of assets. 1.1 trillion of that is in managed fee-based accounts. 18.2 billion in the first quarter had shifted to the managed portfolios. And I throw this out to give you a sense of how money is shifting in the way it's being managed, broadly speaking, and how you're able to invest those dollars. So a penny stock, by definition today, is actually $5. So we need to see more consolidation, more mergers and acquisitions throughout the industry in order to get a greater market cap, so more investors can be tapped into across the world to basically deploy the investments and help grow the companies across the board. So it's a bit of a different angle when you look at it in terms of M&A and deal flow. And maybe I'm getting ahead of ourselves for the questions a couple further down the road, but I just want to throw that out as a kind of
Absolutely.
a big picture and let the other guys talk more to the deals themselves.
Now, we had one of the execs of Newmont Mining on the program, and it dawned on me they were boasting of 92 million ounces of reserves, and but what's the future look like? They have to get involved with M&A, and then at PDAC this year with Rob McEwen of not quite the shoes of Newmont, but he was strongly saying that he will grow his company by M&A. So that we should see more of that. Ryan, why don't you make a comment here on this?
Sure. I mean, I guess from our perspective, it's funny. I think people often cite the gold price and, how it's sort of stagnated around 1,300 today, and that being sort of an impediment for things doing well. And we actually think a bit of the opposite in the fact that, we actually do see a lot of deal activity in the background. We've seen a couple of quasi-hostile offers so far this year, which are typically rare. We see a lot of activity below the surface. And, I think companies know that they need to grow or at least maintain what they have currently. And they certainly did not spend the money during sort of the 2013 through sort of 2016 period. And it's only been recently where they've really kicked it up a notch. But at about 1,300, having the price stable is actually very helpful and conducive to M&A activity, only insofar as that you've got boards and people managing these things, and the fact that they view that as a stable price to use. It's much harder to convince a board or other managers or other people, for that matter, to actually do acquisitions when the prices are really rising or really falling, because you have these changing goal lines. And you have the acquirer not willing to pay a lot more if the prices really ramp up. And then conversely, if they're going down, no one really wants to do anything. And so actually having a gold price flat, actually for the time being, is likely to be more conducive to M&A. And that's how we sort of view the world today.
Go ahead, Chris. Chris has a train to catch, so let's get some of his views before that.
Thank you. I think it is a good time to do M&A. For example, there's a holding in our fund called Midas Gold, and the CEO of the company's in the room today, Steve Quinn, and they just did a deal with Barrick, and where Barrick bought a percentage stake in the company, and that's a great project, and that's a project that should get built. It's strategic to Barrick because Barrick needs their ore feed. Relative to its autoclave at the Goldstrike mine. So it's something that works. It can work for everybody. And if Barrick were to do a deal with Midas. Midas is trading at a significant discount to its net present value because of the big capital spend that'd be needed to bring the mine into production. So if Barrick does a deal whereby a step in the process, in the processing scheme can be eliminated, and the company, the Midas mine, doesn't need to process to roast ore per se, or oxidize its sulfidic ore, and instead send it to the Gold Strike autoclave, that'll bring down the CapEx. And again, if a deal's done, we could get a big premium on our Midas shares, and Barrick could get a really good deal. And Barrick, like Newmont, needs reserves. Barrick needs to, it's trading at a premium to its net asset value. Barrick is. So if Barrick can do a deal again where it buys something at a discount to its net asset value, which would be a big premium to us as shareholders, then it can justify its current premium to its NAV. But they have to be willing to pay the premium. They can't just be willing, they can't kind of say, well, we need to get it at a 30% premium because we're worth a lot more than 30% more than where it's trading now.
No, the upper tier has to go shopping with the lower tier to replace those assets, because if Newmont's going to keep those levels that they talk about, where are the exploration dollars being spent? Trey, do you want to make a comment before we move on?
I think the reason why there's been such reticent M&A activity in the last couple of years is shareholders as a group are telling companies, to be really damn careful because so many mistakes have been made, and unless the deal is, all the deals that I can think of this year, Alamos, et cetera, almost everybody's upset all the time just because nobody, has the confidence that managements have a plan or that there's enough upside in the gold price. So I think people are really reticent. I totally agree with the 1250, 1360 thing. Everything's a Rorsch ink blot for gold in that group. Everybody who hates it sees something they hate, and everybody who likes it sees something they like. But until you break one way or the other, it's all a big rounding error. And I do think breaking above 1360 will help. You made a comment about passive investing, and we were talking about this early. CIBC put out a report to show you how moribund gold stock investing has become. In 2011, CIBC estimates that there were $54 billion in managed gold funds, and 6% of it was passive. And the number today is 30 billion, so it's just about half, and 65% of it is passive. So we've gone from 94, 95% active down to 30. So that's there's the perception is there's absolutely nothing going on in the group to get shareholders excited, and I do think that the majors are therefore very trepidatious about making a mistake.
Let's move on to the second topic here. Is a cost-cutting narrative hurting the long-run profitability? We'll start off with Ryan with this one. Hurting the long-run profitability of the sector. Can gold miners afford drops in production at this point in the cycle?
I think, we've had a good run of cost cutting. Obviously, we've started to see some costs rise. And I think what gives us the greatest confidence in the gold price and where we are today is actually the reserve life for the average mine in the industry today. So currently it's about 12 years, which by our numbers is circa an all-time low. And we have data sort of going back 30-odd years. And so that gives us great confidence that you can at least have a 12-year life, but that's not that long in the context of mining. And so therefore, it is very likely that, I think costs will probably stabilize, and I think you're very likely to have a reasonably strong gold price. But the biggest problem the industry has more than I think anything else is just the quality of projects out there. And I think, we hear, and we see that a lot of companies are waiting for, going back to the M&A theme for a minute. But the longer you wait, obviously the top quality not always goes first, but typically is the most sought after. And then as you roll down the line, you sort of have less and less choice. And I think once this sort of thing gets going, I'm not too worried about the costs at the minute. But on the other hand, we're a lot more focused on the quality of project from a technical level, first and then an economic level after. And I think one thing that the industry really has to do is find new high-quality projects, but that's just not happening. So unless a new technology comes in to change the cost structure of the business, we've seen a few examples, it's going to be difficult to eke out any more gains from that perspective.
We've heard about some quality projects here today in many of the presentations. Anyone else on this?
Yeah, I think the cost cutting is not hurting the industry. I mean, it's helping the industry, but the issue is that because costs have been cut, there are lots of these big companies that are trading at premiums to their net asset values because they haven't explored, they haven't found new mines, and they haven't delineated new projects. And so, again, it speaks to this whole concept of, again, with the passive investing, like Trey was saying, all this money is going into the big names. So you have Barrick trading at a big premium, Newmont trading at a big premium to their net asset values. So then how do you justify that from an active manager's perspective? And they have to do something to justify those premiums. Otherwise, the stocks are going to decline towards their net asset value. So it's not, so the cost cutting is helping the industry by and large, but it might be hurting these companies' share prices down the road. And that's the big
Helps today, but what about tomorrow? Go ahead.
Yeah,
David.
I want to go back to this issue of passive investing and scale, because I think it's critical to understand. When I saw a recent study that only 17% of managers beat their index, and this is what's driving all of the reallocation of capital into these passive structures, and I think it's important to understand why that is. And the answer is that in our banking system at large, the more assets you have, the lower your cost of capital is, right? The lower your debt is. And when that happens, it means you become more competitive, you can price out your rivals, you can acquire them. And so if you look at the economy over the last 30, 40 years, there's been a huge movement towards economic concentration because of this. When you think about what an index is, most all of them, especially the S&P 500, is a cap-weighted index. And so it's not passive at all. It's very active. It's actively investing in the biggest companies that do the best in our banking system. And so, of course, the gold industry, not understanding this dynamic, tries to mimic it. And when I look at the performance of the ETFs versus the performance of the privately managed fund in the gold industry, is the opposite. Almost every private fund I monitor beats the index, beats the ETF. And the reason is because in the gold space, scale is your enemy. Right? I mean, every cycle we see the Barracks and the Newmonts chase these huge mega projects to go for scale, borrowing lots of money on the banking system, mimicking what works everywhere else. But in the gold space, if you're a tiny company with high grade, you can have a much bigger profit margin than Barrick or Newmont, and there's no way they can price you out of the market because gold mines are not in competition with each other because the above ground supply is so enormous. So
We haven't practiced this, but what he's describing, I have the term for it. It's called negative survivorship bias. Gold mining is the only industry with a very, very strong negative survivorship bias. And yet all the indexes are cap-weighted towards those companies.
Exactly right. Exactly so. And so all the capital is going in the wrong part of the business in the gold cycle, and it's a huge opportunity for active managers, of course, but it also means you get lots of misallocation of capital.
Yeah, and I think what we should also remember too, I mean, with the higher multiples implies a lower cost of capital. And so one of the things that the big guys should fear is that, ironically, if their production declines, it is very likely that their actual cost of capital will increase going forward. And so they'll be battling that headwind. And frankly, when you look at, as you point out, it's a small sector with, not that many high quality projects available. And so it's very tough for those guys to do anything of note, of high quality. And so when you look at them, it's very difficult to see how they're going to do it. But on the other hand, in our view, is as long as you're exceeding your cost of capital, you should be okay, and you shouldn't be afraid of it.
Any other comments on that before we move on? Let's talk about M&A now. When will M&A pick up in a big way, or any sort of way? Will this year be something, or will it be 2019 or 2020?
I think it'll be when the big guys start to get scared. I think, I don't know who said that, maybe Trey said that, but in terms of when they go, oh, well, wait a second, because the rallying cry over the past years has been cut costs, and they've done it. And now they look out and they go, oh, wait a second, production's declining, wait a second, our cash flow's declining, wait a second. And so I think when they come to that realization and the fear starts to set in, then I think that M&A will start. And on the other side of that, I think that if the gold price rallies, so that that's if there's a flat gold price. If the gold price rallies and it goes through 1,400 and stays there, I think that the greed kicks in and they go, well, look, let's get this other projects built. We're generating lots of cash. So I think it's going to be on a flat gold price. I think it'll take maybe a couple of years. The gold price spikes, I think it'll happen pretty soon.
Anybody else on that?
Yeah, I mean, just from our conversations with all the different players, and I think we're going to see it relatively soon. I think one of the stumbling blocks for the industry is the boards for many of these companies. I think some of them are hesitant to open their doors to others, and I think that has to change a little bit to get things going as well. From a shareholder perspective, I mean, if anyone sees anything on our list of things we own, feel free to approach us about it, because we'll have a view on it and more than willing to talk about it.
Very good. Let's talk about which projects and jurisdictions are grabbing attention in the exploration space. So is any...
Yeah, I think that it's really, North America is the key, and primarily, again, within North America, Canada, and the U.S., obviously, because there is so much political unrest going on right now in the rest of the world. And we've seen things like Tanzania essentially is, by and large, nationalizing Acacia's gold mines. And then we see things in the DRC, they're wanting a pound of flesh from the miners. And then we see, and they all kind of see what each other are doing. And when the companies just accede to whatever the countries want, then the other governments say, okay, let's do it ourselves. And so I think that'll, in a country, the last ones to fall will be the United States, Canada. United States, it won't happen just because it doesn't matter. Mining doesn't matter in the United States. In Canada, mining's really, really important, and so I don't think it'll happen there. And then Australia too is a good place because again, that's an area where mining's important, and also, for whatever it's worth, there's still somewhat of a rule of law in all of those three places. That's debatable, but I mean, in the United States, we still have a little bit of rule of law.
Any of you have a...
Yeah, just to reinforce that point, mining is an industry where you can really calculate with precision what happens to your NPV when you change discount rates. And the discount rate, there are two components. There's the natural discount rate and then the entrepreneurial discount rate. And when you're in an African country that's changing its tax code, then that discount rate spikes. And so for any given deposit, obviously the lower your discount rate is, the more valuable it is. And the more volatile that discount rate is, the less capital wants to come and invest in any long-term assets. Once you've built the mine, you're pretty much stuck. You can't leave the country. So, I mean, there is signaling involved. It does constrain the government somewhat, but when they get under pressure, they raise taxes. I'm convinced that the U.S. and Canada will also raise a lot of taxes, as they did in the 30s once we get to that point. But no one cared because at least you had a tax to pay when things were that bad. I think gold miners were making money. We'll get there, but as you say, we'll get there last. I think the focus is shifting more towards the first world, away from some of the more volatile parts of the world.
Well, Trey, I know Eric Sprott probably has some favorites in working with Eric. You have any projects that really you think are attractive, at the top of your list?
I'm a little bit in a different camp on the, I guess we call it the creeping confiscation movement that's being talked about a lot in the press in Africa. I mean, there is this old phrase, you got to go to where the gold is, and these things go cyclically, and there's definitely, I think we're sort of more than halfway through that cycle, if you know what I mean. So I think there's reasons why Mauritania did what they did. That mine changed hands for billions and billions of dollars, and they didn't, make a penny. So maybe people in some of these countries weren't doing their homework and setting these things up for proper participation from, with the governments. People like Mark Bristow, on the other hand, have done a great job at, putting in stability packs and that type of thing. And what's going on with the Congo is really reminiscent of how Trump works, right? So, they said, okay, we're going to take everything, 50% of everything over a 25% increase. And, the mining companies said, well, that's terrible. And, Kabila met with them, and then he said, we're going to do this. And now they're in the negotiation stage. So my guess is Friedland and Bristow and these, larger than life executives will work out a pretty good deal. And I think there's a little hysteria in that regard to some of them, to take, it's a large company, but Randgold, for example, has, taken a 20% penalty on what we figure is an $11 million hit to their cash flow. So I think we're kind of past the middle cycle there. And they're at the large end of the spectrum. There's some, probably some stocks that have been over penalized.
Well, Adam, off the script now, has the dollar taken over as the safe haven versus gold? Or if you think so, when will gold return as the safe haven investment?
I think we have to look to the vehicles that are available for investment at large as it relates to gold and gold miners. So we've seen a tremendous amount of flows with interest rates rising into ultra short income fund vehicles as deposit base under the wealth management umbrella. And for gold, we're one of the largest holders of GLD in the world. But in terms of where those dollars flow for gold as gold miners, we have to look to the passive index funds, and a very limited amount of gold and precious metal managed funds, some of which are approved on our platform for investment that are guys sitting next to me here, and others are not. And so what's the future, I think, of the ability to have a larger scale investment into gold? And then that brings up kind of another point, which maybe deviates a bit from the question, but is something that I think of interest. And you mentioned earlier in terms of another mining executive who talks a bit about scale in indices for gold miners. If you look at the S&P 500, we've got one mining company that's in there with a $21 billion or so market cap. And if you look at the universe within the gold mining companies around the world, I think less than 1% would be eligible. And then, further to that, if you do see companies that are listed in the U.S. that can get scale enough to get to the 5 billion plus market cap size, which I know is much, a multiple of the companies that are presenting here, but perhaps as a result of M&A, you can get that investment from the index flows. And one interesting example that I would point to this morning, you may have seen, Twitter is now being added to the S&P 500 and replacing Monsanto, and their daily average volume over the last 10 days was made in the first half an hour of being listed. So the point I'm getting to is, what's the industry doing is my question in terms of how companies are positioning themselves to tap into an investor base that can help with the daily average volumes, who can help with market cap growth, can then become a larger part of that of the broader wealth in the world.
Daniel, I know you want to make a comment. Let me make a statement about Daniel Oliver is writing a book about the 5,000-year history of credit bubbles. So,
and you just made a great point, which is that companies are not run for cash flow. I mean, ideally, you don't care who's opening your stock because you have so much internal cash flow and you're invested or you get banked at or whatever you do. If you're relying on your paper to be high from these index fund inflows to do M&A, I mean, that tells you that you're not getting valuation or cash flows. And so the companies don't care about cash flow, they care about their stock price, and that means they dial up leverage and all those problems. But I want to go back to your original question about the dollar. And in my view, when you look at the dollar as a system, there's about $4 trillion of base money out there and about $90 trillion of dollar-denominated debt. And that debt requires interest payments all day long. So the dollar is in a perpetual short squeeze. And when the Fed dials up interest rates, the requirements of borrowers to meet their debt increases, so the dollar goes up in value. That's the short-term effect. The long-term effect is that it crushes the value of the Fed's assets. The Fed owns, the Fed used to own back in the 20s, 30-day commercial paper and overnight debt, government paper. Now it's 30-year bonds and real estate debt that has increasing duration as rates go up because no one refinances. So the Fed's assets are very impaired, and as rates go up, it becomes more impaired. And so my view, once that short squeeze breaks, once the rising rates start causing wheels of the over-levered economy stop popping out, you're going to see the dollar have a enormous decline, 1970 style, and that's when gold will go up in nominal prices, and we'll realize that's the only safe haven left. And I think we're not far from that point.
Trey.
You implied that the dollar had regained some safe harbor status when you asked the question, and
It seems so, yeah.
this is where I sort of get, the typical conspiracy, self-impeaching, anxiety, because in the last 5 years, there was 9 months where the dollar went up, right? That was June of 14 to March of 2015. And the entire other 5 years, it's been, if you'll excuse me, a bit of a shit show, right? And now, last year, it's down 10%. Had a horrible beginning to this year. We're going back, one of the worst performances in 15 months, going back, 30 years. And everybody on a little bump says, oh, the dollar's rallying, the dollar strength that everybody's been looking for 5 years. We've had it for like 3 or 4 weeks. So in my opinion, the dollar is clearly in the beginning of another cycle down, which is probably going to be 15 years or so. And if you look at what the dollar does on really bad days, Peter Schiff did some work on this. If you go back, 2010 to 2007, whenever the Dow was down 100 points or more, the dollar was up like 87% of the time. If you look at the last 5 years when the Dow's down, the dollar is down about 80% of the time. So I really think the dollar it's like a figment of people's imagination that it's functioning as a safe harbor. The facts are there's a huge resentment of the dollar standard system globally, which is really starting to get some grist behind it.
And I think, too, it's important to remember what you're measuring the dollar against. So if you're measuring it against other currencies that are also getting debased in equal proportion, you actually don't notice a difference in the debasement. So if you measure it against something like gold, you'll actually see probably the real debasement take place. But just getting back to the point about interest rates, in our view, sort of the most important thing is real interest rates when we think about how the dollar interacts with gold specifically. And I think 2 things to note. For every 100 basis point increase by the Fed, you're going to have U.S. deficits increase by about $150 billion a year, and half the $20 trillion debt needs to be refinanced in the next 3 years. And so it's not like we've got a little bit of debt hanging around, and not only do we have a lot, but we have a lot riding on low interest rates. And if you actually normalize it to the average interest rate for the past 100 years, the interest cost alone is going to be bigger, way bigger than the largest deficit we ever produced before the crisis. And so to think about that for a minute, so just paying interest. And that's what sort of scares us into thinking that gold will likely remain the store of value it's always been.
The federal government, the left pocket's buying from the right pocket, so watch that. Any questions from the audience? Go.
Yeah, do you, talking about the majors trading at premium to asset value and the agency problems with these large gold mining companies, do you think investors would be better off, notwithstanding the liquidity constraint, focusing on the smaller companies?
Yeah, I mean,
Takeover potential, then also
yeah,
you
I
have
mean,
companies that are focused
yeah.
on their projects, not on
Yeah, yeah.
empire building.
I think so. I mean, I think that the risk, though, is that they don't get the capital, right? So, I mean, the biggest impediment, I think, I'm going to pick on Stephen again, but the biggest impediment to Midas's project reaching its net asset value is not the project or any technical aspect of the project, but more so its ability to be able to get the $1 billion that it needs, $750 million to $1 billion that it needs to actually build the project. Once it's built, I mean, the stock's trading at $1.10 a share now. Once it's built, even after having diluted themselves to raise the money, it should trade at close to $4 a share or more. But getting that cash is really hard in this market, especially when, all these issues we're talking about with passive management. The passive, like ETFs, don't give Stephen money to build his mine. And so I would say yes, there's more opportunity there, but you just have to be worried. One thing to pay attention to is the amount of capital that needs to be raised to get the projects to approach their net asset value.
Yeah, we strongly believe that the better place to be is in the small to mid cap area. I mean, I think, inherently, I think it's functionally easier just given that the value to be created independent of the gold price change is much more likely to be larger, either whether they're doing exploration development, which is typically functions of the smaller cap guys, whereas I think sort of the best you can hope for the large cap guys is some sort of production optimization, or maybe they do have a skill set in development, certainly probably a little bit less of an expertise on the exploration side. So just the value creation aspects just inherently tend to be in the earlier stage, smaller things.
We're a little over time. I'm just conscious that, Chris, you needed
Yeah.
to get dash. I'll break it there for you, but we can still take the question if we can just let Chris make his move.
I would just also add,
Take care,
just
buddy.
briefly, in regards to accessing that capital and financing, as someone who was previously on the institutional commodities group where we were financing gold mining projects, it is tying to the jurisdiction question. And typically, U.S. investment banks will focus on North and South America and are more comfortable with assets there, and perhaps European and Asian investors more comfortable with Africa. So it also depends on where they're going to source their financing and what's the temperament for banks, their appetite to finance these projects, and it's fairly limited at the moment.
One thing I've been impressed about so much today with the presenting companies is the quality of the assets, and then what the institutions, some incredible positions, and so they're looking for quality in this junior sector. Yes, sir, back here.
Yes, my question has to do with Barrick. At their investor day, they said they would be happy to make M&A, but their main focus was to have the highest growth and free cash flow in the industry. So their goal is a 15% IRR on $1,100 or $1,200 gold, and they would be happy to either shut down mines, mothball mines, shrink, but have free cash flow grow. And they also said that they probably have the best assets in the world in Nevada, so why not maximize those? And
Sounds like a company with way too much debt.
yeah.
I think inherently that's actually a really good plan. I think, again, the one problem they're probably going to run into is that there are limited opportunities to reinvest in one specific area. Their assets are fantastic in Nevada. But I think the problem is, if you're going to generate a large amount of free cash flow, which they will be for the next few years, it's going to be very hard to redeploy that full amount in that one specific area without doing investments that are likely below 15%. And again, when you look at, I guess their framework, I would argue, might be a little too rigid. 15% for the industry is, at their size, I would suggest would be very difficult, considering their cost of capital is probably one of the lowest in the space. And, let's say their cost of capital is 5% or maybe less, depending on how you measure it. They're looking at a 10 percentage point spread, and there aren't too many industries where people are getting a 10 percentage point spread between their cost of capital and what their returns they're going into. And I think they might have some difficulty in executing that.
Well, they have Nova Gold, which is a huge project, but they said they won't invest unless they can get that 15% at $1,100 gold. So they're drilling to reconfigure the project. So maybe it's only $1 billion, or they do it in steps.
If they could do it, that'd be fantastic. Yeah.
Right here in the front.
Okay, so this is addressed to everybody. Well, I read you a column, Trey, on Sprott. This is addressed to everybody, but I read you a column, Trey, on Sprott. When I was in my 20s in the 1970s, gold started the decade out at $35. It ended at $8.75, so that's like an increase of 25 times, and I was smitten, and it never went away. So my generation now is, I'm not saying dying, but retiring. And I speak to my son. I have a son in his 30s, and he has absolutely no interest at all in gold or silver. He did buy cryptocurrency. So what are we going to do to spark the interest in people? Because it seems like we need someone to generate more interest in this sector. Thank you.
Well, an anecdotal, my youngest son is 19. He's a rising junior at Tufts, biomedical engineer, smarter than the rest of us. And he started flipping around cryptocurrencies around Thanksgiving of this past year. And he came home once and, again, smart kid, but, I asked him, how many trades have you made? And so he showed me his trades. He had 2,100 trades since from November to December 24th. So in late March, I started calling him and I go, do your taxes yet? So I do think, I do think the whole sort of trading, flipping them around thing, when the millennials, are finally called by the IRS and say, hey, where are all those trades you were making, it'll sort of die its natural thing. We at Sprott have a joint venture with a thing called Tradewind, which is sort of, I don't want to get off topic, but it's a blockchain-based gold trading network with IEX so that you can actually buy gold in physical form, held at the Canadian Mint through the blockchain instantaneously. And of course, it's very hard to get this type of thing off the ground. It shows up in Kitco now if you go down to their list of products, below the Austrian Philharmonics and all that stuff at the bottom, it says digital gold. So I think it's possible that I might be able to convince my son Christopher, when he's flipping them around in between classes, that maybe he could keep a little of his capital in gold in digital form. So I think that's possible. It's possible to start to get a little bit of that. But the average guy who buys a gold coin is a 65-year-old white Republican, that's literally who buys gold coins. And with Trump in office, they're not worried about anything. So gold coin sales are all down like literally 60-70% year over year. So what do you guys think it'll take?
Let me share a fun fact with you, which is that since from 1971 to today, since Nixon took us off the gold standard, the rolling 12-month volatility of oil prices is 64%. When you price oil and gold, it's 40%. So what pricing commodities in gold does is it lowers the volatility right now. Now, this is extraordinary because for at least 100 years, economists have been telling us that gold is just another commodity, right? It's not money. We can have better money. I mean, this is Keynes, Irving Fisher, so on and so forth. So for 100 years, the smartest guys in the room have been saying, forget about gold. And yet the market still makes prices of gold so that other commodities shrink the volatility against it. In other words, the market still treats it as money. And the point of this is that money and markets are emergent properties. It's not because people decide, all right, let's make gold money. It's because that is what happens because of the nature of gold, the nature of other financial instruments. So it doesn't require educating people or active management to get people to put their money into gold, capital flow to make gold go up or make it behave as money. It does that naturally. And so I think what will happen is as the dollar starts collapsing under its own weight, under the weight of the balance sheet of the commercial banks, under the weight of the balance sheets of the Federal Reserve, gold is going to start going crazy because of its natural properties. And at that point, people will follow into it. They won't lead it, they'll follow into it.
I would add the World Gold Council was created about a decade ago, coinciding with the GLD gold ETF, and part of their mandate is, I think, to promote gold. So maybe they should hire some more PR people.
And I think actually cryptocurrencies will actually help gold actually put it in a format that's more accessible, frankly, and appealing to the younger generation. I think they're actually natural complements for one another to be linked. So to the extent that happens, I think it could only help gold.
Here in the front.
I have two questions or comments. The first one is, I've noticed that when anybody asks you a question, you always answered it as if you were a US or a Canadian investor. When you're talking about gold, you must remember that most of the trading in gold does not take place either in the United States or in Canada. And physical gold and paper gold are ways that you can invest in gold. And one has to think about that side of the demand picture as well as the US and Canada. The other thing was on M&A. I'd just like to make a comment. The way that managements of large gold companies goes in waves of about 5 years at a time. And up to about 10 years ago, or 5 years ago, it was just acquisition of ounces. And Goldcorp paid, I think, $1,000 an ounce for the peak of the cycle. And then all the heads of these companies were fired, and you got accountants coming in to run these companies. And they looked at the debt and they said, oh my God, they cleaned up everything and they got rid of all those ounces. Now we're in another cycle where, in my opinion, and I'd like to know what you guys think also, where managements are going to have to replace ounces because we're in a depleting commodity. You're mining it, and once you've mined it and you've sold it, it's no longer there. Exploration has been flat for 5 years. So they're going to have to, at some point in the next 2 to 3 years, replace those ounces.
On your
Like
first point, the reason that we talk about gold in dollar terms and the dollar is because there's nothing in the world to which gold is correlated over a long period other than its negative correlation to the dollar. That's it. It's 82, 84%. And you can have 3 or 6 months where you could even get a positive correlation of gold to the dollar. But gold is all about the dollar. It's all about the dollar standard system. It's about your, as Jim Grant would say, the reciprocal of your confidence in central bankers. I mean, it's all about the dollar. And we can stand up here and say, Chinese demand, Shanghai deliveries, offtake, Indian ex-duty premiums. It's all important. And that's 50% of physical demand is in those two countries. But it's been that way for 5,000 years. So it's really all about the dollar. And so that's why, as a gold investor, you have to focus on your views on what the dollar is going to do for the next 5 to 10 years. If you're comfortable with the dollar, you shouldn't be wasting your time on gold.
Yeah, and Jeff, and the real point is that gold doesn't really move. It's the least volatile asset. That's why man has chosen its money for 5,000, 10,000 years. It's the dollar and other currencies that move around it. So, you always have to flip your perspective on that. But I would also point out that when you look at the gold price and other currencies, most of them are up towards their all-time highs. It's really only the dollar that still is massively lagging, and we forget that, I think, as Americans.
And just on the M&A front, actually, we should not forget that a lot of foreign, maybe even state-owned companies want to be in the M&A business. We had a meeting with a large Chinese company not too long ago, and they plan on doubling in size through M&A exclusively. And they are not alone, because we've had others in other parts of the world. And so they have a different view, I would think, than probably most other Western countries, certainly on gold, and probably more influential in the policies for some of these companies. And they're not shy about doing M&A because they don't have that, they're tasked to do that. And so we know of several that are actively looking, have made some investments already this year. And we think they're going to be in direct competition with the publicly listed companies. And so, they're all competing against a scarce resource. And we think that could only be good for, going back to the small to mid-cap guys, could only be good for them.
And I would just add, if over the last 5 years the concern is that we're having a lag in mine supply, then from my days at CPM Group as a metal researcher, it's should be good relative to demand to the price over time. But I would say more so for the rest of the precious metal and base metal complex to trade more like a fundamental asset.
Well, we want to thank a very excellent panel.